Hey guys, and welcome to lesson number 1, which is learning all about market structure. Right, so market structure is something very key that you have to understand on a fundamental level in order for you to excel your trading journey. Not only is market structure relevant in everywhere you go in your trading journey, but it is also the biggest key in your actual trades themselves, because market structure will tell you everything that you need to know about where the market currently is, where it's going in the future, where it's coming from, what's happening around the world, because everything is priced in, right? In this little leg of price, it tells you everything that has happened with the euro versus the dollar, because it shows you where price is, what's happening with it, where it's moving to, where it's going. And news isn't just affected by things such as CPI news or PPI data, but it's also affected by little things such as the weather. It's also affected by major things such as world wars, geopolitical news. There's so many things that the markets are affected by that you have to understand that every little thing in the world is going to play some sort of role in shaping where the markets go today and where they end up tomorrow. So the number one key that you have to learn before you do anything is there are 3 stages of the market. You have a bullish market, right? You have a consolidating market, and you have a bearish market. So all 3 of these, as nice as they look on paper, just like this, they will never look as nice on the actual charts, right? So how do you identify what a bullish market is? So in a bullish market, you're going to have a leg up, you're going to have a pullback or some sort of retracement, and then you're going to have another leg up, right? The second leg that goes up will always break the original high. So let's put some names to what is actually going on here, right? So let me get a text box out so that we can actually start typing. And this is called a higher high, right? So this is classified as a higher high. After a higher high, you then see a higher low, right? So in a bullish market, you're going to get higher highs and you're going to get higher lows. And when you see higher highs and higher lows, you can then safely say to yourself, I'm in a bullish market. So for a higher low to be valid, the higher low has to break a higher high. So for this leg of price to be valid and to be classified as a higher low, it has to break this higher high. If price doesn't break this higher high and fails and comes back down, this leg can no longer be classified as a higher high because it didn't break this higher high. I hope that makes sense, because in a bullish market, you want to see a higher high, then a retracement into a higher low, and then this higher low has to break this higher high in order to create a new higher high. If it doesn't break this high right here, then it is now turning bearish because it has no longer created that new higher high. So in a bullish market, you just have to understand that a higher high comes, then you see a higher low, and then this higher low will break this higher high, giving you a brand new higher high, which will then give you a new higher low. But for this higher low to be classified as a valid higher low, it cannot break below the previous higher low, right? So the new higher low that has just formed has to be above the previous higher low. And in a market where you have everything played out just as beautifully as this, you can then safely say that you're in a bullish market. You have a higher high, higher low, higher high, higher low, right? And so on and so forth. So when the markets are moving like this, you can safely sit and tell yourself that you're in a bullish market. Therefore, you should be trading with the trend and you want to be taking buys, right? Then you have the bearish market. So instead of a higher high and higher low, we're gonna get lower lows. And then after a lower low, you're gonna get a lower high. So let me just pop that on here. And then this is exactly what you're going to see as the markets continue to play themselves out. You're going to see lower lows and lower highs, right? So let me just put this onto the charts for you guys. So we have another lower low here, and then we have another lower low here. So just like in the example of a bullish market, for this lower high to be valid, it has to break this lower low to create a new lower low, right? So you get a lower low, then you get a pullback or a retracement giving you a lower high. And then for this lower high to be valid, it has to break this lower low, giving you a new lower low, which will then give you a retracement, giving you a new lower high. But for this lower high to be valid, it cannot be higher than the previous lower high. So it has to be below the previous lower high, right? So then once you've got the lower high, you're now looking for a new lower low. And you only get a valid lower low when it breaks the previous lower low, giving you a new lower low, right? So just like in the bullish example, we're just inversing exactly what has happened. So you're getting new lower lows and new lower highs, and you can then safely say you are in a bearish market. Therefore, you are now looking for sells, right? And the last example that we have is this right here. This is something that we do not like, and this is just consolidation, right? This is where you're not seeing any clear breaks of structure. You're not seeing lower highs or lower lows. You're not seeing higher highs or higher lows. You're simply just seeing a sideways market that's not doing anything significant. It's not breaking any highs. It's not breaking any lows. It's just going sideways. In a sideways market, you have to be very careful because it's moving sideways and it's not telling you if it's making a higher high or a lower high or a lower low. You can't then judge the direction of the market, which means essentially you end up becoming a gambler, because without understanding where the market wants to go next or what sort of market there currently is, how can you then try and place a trade when you don't even have a overall bias of where you want it to go, right? So it's just like driving a car. Imagine if you got into the car and you didn't have a destination and you just started driving. Wouldn't you simply just be wasting your fuel because you have no idea where you're going? Now that is what consolidation is, because it's not doing anything. It's not going anywhere. Whereas with a bearish market or a bullish market, you're making significant structure changes which give you a directional bias, right? So having said all of that, all of these are very nice to look at and all of these are very nice to mark up when they're just lines. But when it comes to the actual markets, it's a little bit harder to actually see all of these things. So what I'm going to do is I'm going to mark out exactly what I'm seeing so that you guys can then also see the markets, right? So instead of using the highlighter tool, let me use the brush tool because that's a little bit smaller so you guys can actually see what I'm drawing. So if we start looking at price from here moving forward, right? As you can see, we've got this leg of price down. So here we can call this our lower high, right? Now here we get a lower low. Then we get a push up, giving us a lower high. Then we get a push down, giving us a lower low. Then we get a push up and a push down and a push up and a push down. So can you see that we broke this right here, and right here? So like I said in the examples that I was given just above, for a lower low to be valid, it has to create a lower high, which cannot be higher than the previous lower high. So as you can see, this was never higher than this. Therefore, this is now a valid lower high. Now, this breaks structure to the downside, giving us a new lower low, which is lower than the previous lower low right here, which means, again, that is a valid lower low, right? Again, we get a lower high, we get a lower low, we get a lower high, and we get a lower low, right? So that is a bearish market. Okay, so let me remove the drawings off the screen, and now let's move over to what happens next, which is now a bullish market, because what we get is a higher high, a higher low, a higher high, a higher low, a higher high, a higher low, and a higher high, right? So if we again take this, we can see that this higher high right here gave us this higher low, which was higher than this higher low, right? So then when we got this push up, we now broke this higher high, giving us a new higher high, which then gave us a new higher low because it was higher than this previous higher low right there. And then we got a higher high, a higher low, and a higher high, right? So that is a bullish market. So let's remove the drawings and simply just draw out the breaks of structure. So we've got that right there, we've got that right there, and we've got that right there. So as you guys can see, we are continuously breaking higher highs and creating higher lows, which means this is a bullish market, right? So can you notice something that happened right here in this leg of price? We went from creating lower low, lower high, lower low. Now the anticipation was we would create a lower high before creating a lower low, right? But that did not happen. Instead, what actually happened is we got a lower low, a lower high, a lower low. Now we failed to create a lower high by breaking this lower high, which means this can no longer be valid bearish structure. This is now bullish structure because now we've created a higher high breaking this right here. Now we get a higher low, a higher high, a higher low, a higher high, a higher low. So this right here was a market structure shift. This is where we had a shift in structure from bearish to bullish, right? So that is bearish price action and bullish price action with a significant change in character where we went from bearish to bullish, right? So I hope you can understand what market structure is, what it's doing, and how you can then identify all of the points of market structure so that way you get a better idea of exactly where the market is going so that you're never actually guessing. Okay? Now, the other thing that I wanted to talk about with market structure is that we are currently on the daily, right? So being on the daily, all of these candles have an entire day's worth of price action inside. That means this candle right here, let me mark it out with a rectangular box because we're about to do something a little bit mind-boggling, right? So let me mark this box out like this. So this candle, this individual candle by itself has an entire day's worth of price action. So if we drop down to the 4 hour, we've had 1, 2, 3, 4, 5 4-hour candles so far, right? Just inside of this one daily candle. Now, if we drop down to the 1 hour, this is where things get a little bit interesting, right? Because let's tighten up the box so that we're exactly at midnight. Now, inside of this one daily candle, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, and then we're expecting a 23 and a 24, right? So we're expecting 24 1-hour candles inside of that one singular daily candle. Now we can take it all the way down to the extreme and drop down to the 1 minute so you can see that all of this price action, everything here, was just inside of this one singular daily candle, right? Now that is crazy in itself because on the daily time frame, this candle looks so small. But when you go over to the 1 minute, you can see that so much has happened inside of this one daily candle, which looks so insignificant on the daily time frame. It's had all of this data inside of it, all of these moves up and down, right? So we can use the daily in conjunction with all of the different time frames to actually frame our trade, because market structure is relevant on every single time frame, right? On every single time frame, you will see the entire fractals of structure happening, right? So just like you're going to see on the daily time frame that I just showed you how the markets were going from bullish to bearish and there was bearish structure, if we take a look at this leg of price action right here, you can see that we had a higher low, higher high, higher low, higher high, higher low, higher high, and then a higher low, failure to create a new higher high, giving us a lower low, and then the markets turn bearish, right? So it's the exact same fractal as there was on the daily time frame happening on the 1 minute time frame. So this is what we can do in order to frame trades, because the fractals that are happening on the daily time frame also are happening on the 4 hour, the 1 hour, the 15, the 5, the 1. It's happening everywhere, right? So the number one key when it comes to trading is understanding how you mark out structure, because then once you've got structure marked up in place, you can then go ahead and start framing your trades. Because if you're in a bullish market like this, right? Let's just give the example. We've now created a lower low, a higher low, a higher high. So now the anticipation is that we're going to get a higher low before a higher high, right? So if I draw this on, let me just draw it like this. Let me connect the dots, right? If we drop down to the 4 hour, you can see that inside of this leg up on the daily, we had all of this bullish 4 hour price action. And then we had this bearish 4 hour price action. And then the bullish, the bearish, the same fractals that are happening on the daily are also happening on the lower time frames as macro fractals, right? Same thing on the 1 hour. The daily is bearish and the 1 hour is displaying all of this bearish price action. Then the daily turns bullish and the 1 hour is then showing this fractal bullish structure, right? So the time frames themselves are actually showing you that no, even though the higher time frame is bullish, on the 1 hour, we may be in a bearish leg, right? So let's just take the example of the current price action on the daily, right? So on the daily right now, we have just created a new higher high, right? So now our anticipation is that we're going to create a higher low. So when we drop down to the 4 hour, we can see that the 4 hour is still bullish. However, our anticipation is that we're going to get this higher low on the daily. So therefore, what we want to see is the 4 hour turn bearish, and then we want to see it turn bullish so that it can do what the daily time frame is showing us it wants to do. If we go then drop down to the 1 hour, we can see that price has to turn bearish for this leg of 4 hour price and daily price. Then it has to turn bullish, then it has to turn bearish, then it has to turn bullish, even though on the daily it is just one bearish push down, right? Then if we drop down to the 15 minute, we can see again that we need price to do all of this in order for it to come down before then giving us a new higher high. So this is how we can then use market structure to start framing our trades. But this was market structure. This was lesson 1. I will see you in lesson 2.